Okay, here we go. This is our first screen capture video for Accounting 101, which relates to Chapter 1. So I have a little homegrown tabular summary, I think that's what they call it in the book, for Jill Jones, CPA. She goes out on her own. She decides to start her own business. So she starts with 0 in all of her books and records, all right? These would be the 4 assets that we're going to encounter in this little illustration. Assets being resources of the business that we're going to employ in an attempt to earn a profit. AR is an abbreviation for accounts receivable. Accounts payable, or any other account ending in the word payable is a liability. It's a debt. And then capital is the owner's equity of the company. Now, in the textbook, they have a whole bunch of other columns out to the right for drawing revenue expense, which really makes a mess of the whole deal. I don't like the way they did that. This is how I do it. So in this column, what are you going to find? You're going to find fluctuations in capital. There are 4 things, for now, that will cause capital to fluctuate. Investments will increase capital. Revenue will increase capital. Drawing will decrease capital. And expenses will decrease capital. That's what will go in this column over here. Capital fluctuations. Okay. Now, an investment. What does that mean? Did we buy Apple stock? No. In this context, it means you took your personal money and you put it into the business. So my first make-believe transaction, Jill takes $10,000 out of her Beauty and the Beast pillowcase and deposits it into a brand new business checking account. Her cash goes up $10,000. Okay. That's an investment. That's going to increase capital. And let's say that happened on January 31st for purposes of this problem. Okay. All right, so once again, you take your own personal funds, you put them into the business. That's going to be an investment that's going to increase your capital. You could contribute other items. That's not going to happen in Accounting 1, but you could contribute other assets as well. Okay, next on the hit parade, what happens? Jill needs some equipment. She needs a computer, a printer, etc., etc. So she goes down to Staples and she picks out a nice computer and printer and so forth. And she pays, including sales tax, $3,000. Okay, now, what did she pay for? She paid for equipment. Now, what's the difference between equipment and supplies, both of which are assets? Well, equipment's going to have long life, used in operations, not intended for resale. It's going to depreciate over time. We'll get to that depreciation part in Chapter 3. Supplies are typically less money, and they're going to be used up quickly, typically within a year. So if you're an accounting firm, what's equipment? Equipment's going to be your furniture and your fixtures and your computers and printers and things of that nature. They all have long life, typically meaning a couple of years or more, and they're used in the operation of the business. Supplies, that's going to be less money. It could be stationery, pencils, pens, stationery, letterheads, envelopes, and go on and on. That would be supplies. Usually less money and used up quickly within a year. Okay. So that's what happened so far. Now we have $7,000 in cash. Got my little totals down here. And we have a $3,000 worth of equipment. So the left side of our accounting equation is equal to the right side of our accounting equation. We got 10,000 on both sides. Yeah? And it's called an equation. That's right. It's called an equation because the left side is going to equal the right side. All right, what happens next? Jill goes to Uncle Normie's stationery store. She loads up with a whole bunch of supplies and letterheads and so forth and so on. Total is $1,500. So she has $1,500 more of supplies now than she had before she went to the stationery store. And what else? Well, she's not paying right now. She's going to pay later. So when you purchase supplies or any other asset, or a service is rendered for you, and you don't pay immediately, you owe the money. It's an informal credit transaction. Your accounts payable goes up. So purchase assets or services on account, what do? Credit accounts payable. Okay? Liability. All right, now what do we have? We have cash, we have supplies, and we have equipment. Totals 11.5 for those three items. And on the right side of our equation, we got 11.5. So these two numbers should always be equal. Left side, right side. What happens next? Jill does a bunch of work for one of her clients. She prepares some reports. She prepares a bill. A bill for what? For the services that she's performed. $2,500. She goes down to the client's place of business, hands over the reports, has a discussion, and then submits the bill, the $2,500 bill or invoice, to the client. Client immediately grabs a checkbook and writes out a check to Jill for $2,500. You say to yourself, self, what did I just get? I just got cash. Okay. Why did I get the cash? From where did it come from? It came from revenue. That's one of the four items that will increase capital. Increase or decrease capital. 2,500. We'll give it a name. There's different names for revenue. I'll call it fees earned. Okay, so if you're an accountant, you might call it fees earned. You might call it professional fees earned. If you're a realtor, you'd call it commissions earned. If you're Macy's, you'd call it sales. There's different names for revenue. Okay, depending upon the type of business you have. All right, what happens next? Jill goes back to the office, does some more work for another client, prepares some reports, drafts up a bill, an invoice for $2,000 for the services rendered, goes slip-sliding over to the client's office and hands over the work, has a discussion, submits the invoice for payment. Client says, okay, I'll give this to my people in the accounting department. We'll get a check out to you maybe in a couple of weeks. Jill leaves. Okay, does she have any money? No, she didn't have any money. She left. She's gone. What does she have instead? She has an account receivable. So, if you do work for an individual or a company, and you submit a bill to them, you invoice, bill, or charge them. Okay, now, is it going to have a happy ending and you're going to get the money immediately? Sometimes. And sometimes you won't. But in both cases, what do these two cases have in common? In both cases, you did the work and you billed, charged, or invoiced the client or customer. If that happened, whether you get the money or not, you've earned it. So the earnings process takes place when you've provided the service and you've charged the customer or client. So what we have in Accounting 1, with Accounting 1 students typically really focus on it. I call it a cash basis mentality. You feel like, well, if I didn't get the money, I guess I didn't earn it. Well, that's not true. Did the work, billed the client. Well, I got the money, good. Didn't get the money, not so good. But in both cases, what do we have? We have the revenue. All right, next on the hit parade. PAID, that's a 4-letter curse word, right? That can only mean one thing. That your favorite thing is just reduced. And what is your favorite thing? Cash. She pays a landlord, whoops, it's $950. Pays a landlord $950. For what? For rent, for her office. All right. So you say to yourself, rent. Is that an account receivable? No. That supplies or equipment? No. What is that? Rent is a cost of doing business. It's a term I like to use with respect to expenses. Cost of doing business. If you ask the IRS, they'll tell you it's an ordinary and necessary cost of doing business. I'll come back to that statement in a little while. An expense will decrease your capital or owner's equity. What goes in this column again? Investments, revenue, expenses, drawing. Expenses decrease your capital. And I'm going to give this a creative name. We paid the landlord for what? For the office? Oh, that sounds like rent expense. Yeah? There you go. It's a very common transaction. It's an expense paid in cash. Next on the hit parade, the mail shows up. Okay, Jill opens the mail. What does she find out? It's a bill from Verizon. It says, you owe us $225 for your cell phone and your landline or whatever. And you have to pay it by, let's say, March 10th. So you got a bill from Verizon for $225 and you have to pay it next month. So you say to yourself, did I use the phone? Yes. Did I get charged? Did I get billed? Yes. How much did I get billed? $225. I owe that money to Verizon. It's an account payable. What did I get? Did I get supplies, equipment? No, I didn't get that. I got the usage of the phone. Let's see, phone usage. What would we call that? That's the cost of doing business. How about telephone expense? There you go. All right. You use the phone, you got billed, you have the expense. You also owe the money, in this case to Verizon. Okay. Next, what happens? We send the unpaid intern into the supply closet. This person counts up the supplies and tells you, you know what? Those supplies that you bought from Uncle Normie, that you haven't even paid for yet, doesn't matter. Those supplies, you only have $1,200 worth of supplies left. So you do a little math and you say, well, if I have $1,200 worth of supplies left, I must have used $300 worth of supplies, yeah? That brings me down to $1,200, which is what I counted. Okay, now if I use up my supplies, what does that sound like? Does that sound like an expense, yeah? Cost of doing business? Okay, now I have these three, one after the other, to illustrate. An expense can come about in a variety of different ways. Here's the most common one that most people can relate to, an expense paid in cash. Here's another one. You incurred an expense, but you haven't paid, you have a liability. And here's a third version. You acquired an asset, which you then used up at some later time, and the expense is recorded. It's three different ways. Okay. Two more transactions. What happens now? Jill finds herself heading south on the New Jersey Turnpike and eventually headed east on the Atlantic City Expressway. She's playing blackjack. Okay. They're giving her free drinks. She brought with her $1,800. Where'd she get the $1,800 from? She took it out of the cash account. And used it for what? Because she lost all the money playing blackjack. $1,800. Okay, let's see now. I decreased my cash. Why? Because I took the money out of the bank account. That makes sense. $1,800. Is there such a thing as gambling expense? No, of course not. That would be personal use of company funds. Drawing. Now we have all four fluctuations here. Investments are going to increase your capital and owner's equity. Revenue will increase your capital and owner's equity. Expenses will decrease your capital and owner's equity. and drawing will decrease. There you go. There's all four. Now in the book, they show these, as I said earlier, they spread them out to the right, which I don't like, Professor Weinstein doesn't like, but anyway, here we go. We received a partial payment. From whom? Oh, from this guy over here. Remember he told you he's going to give it to the people in accounting? Well, he sent us a check for $700. We take the $700 check, and what do? We go down to Scrooge National Bank and we deposit it. Did we just earn that money? No, we didn't. We already recorded the earnings back here. So all we want to do now is reduce the amount that this particular client owes us. So we subtract 700 from accounts receivable. And there you have it, a month's worth of transactions on Jill Jones. Okay, what can we do with this now? Well, do what they do in the textbook and in the problems. What we can do now is we can create financial statements. So let's take a look at the financial statements that relate to this problem. First one, income statement. So every financial statement is going to begin with the name of the business concern. This is Jill Jones CPA. It's going to be an income statement. And it's going to be for the month ended February 29. So you have to indicate the time period. So the user of the financial statement doesn't know, what is this? Is it for 1 month, for 2 months, for 11 months? How many months is it for? All right, it's just for 1 month. All right, fees earned. That's our revenue. So what's going to go on here? Revenues and expenses only. All right. We had 2 transactions involving fees earned. One for $2,500, one for $2,000. Are we going to list them both? No. We're going to add them together and say that was the total for the month. Now this is a very simple illustration here. In real life, there might be 200 entries involving fees earned. You would add them all up, summarize, as they like to say in the textbook, and show the one amount. Okay. Expenses. If you read the textbook, they probably tell you, expenses should be listed in descending order. In real life, it's going to be done on a computer, and you're going to set it up. Who's going to set it up? The accountant's going to set it up, and you're going to probably list the more important expenses on the top. So it'll be set up to print out in the same order every single month. That's reality. Okay, we had 3 expenses, right? The rent, the supplies, we used $300 worth of supplies, and then there was the Verizon bill. What do they add up to? $1,475, those 3 numbers. $1,475. If we subtract the $1,475 from the $4,500, we get the net income. All right? Now that's a good result, right? Because your revenues exceed your expenses, and you are at this point what? You're happy as hell. You have net income. What if it didn't go that way? Then you would have net loss down here if these expenses were greater than the revenues. There's your income statement. What do we put on here? Revenue and expenses only. Okay. Next on the hit parade. Statement of owner's equity. What does a statement of owner's equity tell you? It tells you how did you go from beginning owner's equity to ending owner's equity, or capital, same thing, right? How did that happen? No, well, we know what happened. We know all these things happened here, right? But we know that if you take these over here, the revenues and expenses, we know that the net of all those transactions is $3,025. That's what? That's the net income. Are we going to list that stuff all over again? Of course not. All right, so here we go. Jill Jones CPA. Statement of owner's equity for the month ended again. There's going to be a period covered. We went from A to B in owner's equity, but over what time period? Could be anywhere from a month to a year. We started with $10,000. That's why I said let's make believe we made our investment on January 31st. So we started with 10K. Add the net income. Plug that number in over here. little subtotal, and subtract out the ill-fated trip to Atlantic City drawing. Final Jeopardy answer, 11,225. Are we surprised that it came out to 11,225? Not at all. That's the same number on the worksheet. Yeah? Okay. Here's your statement on owner's equity. What's it tell you again? How'd you go from beginning capital to ending? And I'm using those words in the same context. Capital is owner's equity. Okay. Next on the hit parade. Balance sheet. What's a balance sheet? Well, name of the company. It's a balance sheet. This is a snapshot of the company. How much did we have in the way of assets, liabilities, and owner's equity at a particular point in time? Not on February 28th, not on March 1st, on the last day of the month. So you don't put a time period on a balance sheet, you just put a date. Okay. Some people put as of, but that's it. It's not a time period. So what we're going to do here is we're going to take the accounting equation, which we have over here, horizontal, and we're going to reflect these balances vertically: cash, accounts receivable, supplies, equipment. Just taking these balances here, right? And then getting a total, which according to this is 12,950. Yeah? Here's your total assets. In other words, the left side of your equation equals 12,950. What does the right side of our equation equal? Well, it better equal the same thing. That's why this is called a balance sheet, right? So we have one liability, and then we have our owner's equity at the end of the month. Here's our one liability. There's our owner's equity. 12,950. Numbers are equal, which makes us what? Happy as hell, right? Balances. That's why it's called a balance sheet. Now, let's see. Going forward, is this one going to get more complicated? Well, you could have two revenue items up here, typically. Possibly, we'll put it that way. And yeah, this part down here, you would definitely have more than three expenses. Now, when we get to, I believe, it's chapter 4, we look at a multi-step income statement, which is definitely more complicated than this one. But for now, this is good. Well, the only thing that you're going to see in the near future is you might have more than one revenue item. You'll definitely have more than three expenses, but you still do the same thing. You'll take your revenues and subtract all your expenses to get to net income. What evil things could happen with this one here? Well, you could have had an investment during the month. Let's suppose you put in another $5,000 during the month. Well, you'd have to plug that in over here. You'd have to modify this. Put it over here. Investment during the month, something like that. $2,000. That could happen. Other than that, this is what it's going to look like. Okay, statement of owner's equity. You're going to take your beginning owner's equity, add your net income, subtract your net loss, and always subtract your drawing to get your ending capital balance. How's that look so far? Okay. Balance sheet. Going forward, what could happen here? Well, this is a very simplistic balance sheet. We're going to find out that these assets have a name. They're called current assets, those which you are going to convert to cash or use up within a year, typically. And this would go in a separate category called property, plant, and equipment. That's down the road for us. So yeah, this part will get more complicated over here. But still, it's going to be, your assets added up. What about the liabilities? I lost control of my worksheet. What about the liabilities? Well, we only have one liability. Could we have more than one? Of course you could. Not only could you have more than one liability, but you could have liabilities that you have to pay off within a year. We'll come back to this. They're called current liabilities. And then you could have long-term liabilities, which are payable beyond 1 year. 1 year from the balance sheet date, that is. So if you have anything that you have to pay back before February 28th, 2021, in this case, that would be a current liability. Okay. So yeah, this will get more complicated, but of course when we get there we'll explain all that stuff to you, so it shouldn't be a problem. Now, in the textbook, you're going to have a similar problem like this one that we're going to work out. And I'm going to do it on a screen video as well. And when I do that, I'm going to show you some Excel. I mean, I didn't show you how I did these formulas and things on this one. So I'll use Excel and I'll explain the different functions that I'm using in order to create an Excel worksheet, okay? But that's not going to happen until I go over that problem. So I'll put that problem in this email. What email, you say? Well, the stuff that you're looking at right now, I'm going to put in an email. And I'll put the problem on the worksheet as well that you should try and do after you've obviously gotten the book, read through it, checked out the video, take a shot at it. Okay, so until next time, which will be next week, no doubt, signing off.